March 18, 1980, Lower Manhattan. The lunch rush at Harry's Bar hums beneath the towers of Wall Street, a cathedral of suits, noise, and money. Amid the chatter of traders and the hiss of espresso machines, two men shake hands in the corner booth. One wears a $1,000 suit. The other carries a Brooklyn accent thick as concrete. To the waiter, it's just another deal. But this handshake marks the quiet beginning of a new empire, one that will change organized crime forever. The Mafia has found a new racket, and it's clean, invisible, untouchable. By 1980, the American Mafia was bleeding. The old cash cows, unions, gambling, construction rackets were crumbling under federal pressure. RICO laws had turned whispers into indictments. FBI surveillance blanketed every major family from New York to Chicago. Gone were the easy days of payoffs and protection money. The Commission, the Mafia's ruling council, knew survival meant evolution. And where better to evolve than Wall Street, a world driven by greed, speed, and blind trust. A world where money moved faster than bullets. The first to see it coming were the Colombos, Brooklyn's most ruthless family. Their soldiers had cousins and childhood friends working downtown as stockbrokers, traders, and financial consultants. They started small, running pump and dump scams on pink sheet penny stocks. They'd buy a worthless company, hire slick-talking salesmen to push it over the phone, and sell it off before the crash. The victims were small investors, retirees, teachers, blue-collar dreamers who thought they were betting on the next IBM. Instead, they were feeding the mob. One Colombo associate bragged, "You make more on the phone than you do with a gun, and nobody's chasing you down an alley." This wasn't the Mafia's first dance with high finance. As far back as the 1950s, mobsters had skimmed profits from Las Vegas casinos and laundered them through Swiss banks. But Wall Street offered something new: legitimacy. There were no bloodstains on a brokerage statement, no bodies in the trunk, just numbers, accounts, and faceless victims. The FBI called it the invisible racket. It was the perfect crime for a new decade. In 1981, the Gambino family followed suit. They saw the potential in a fast-growing phenomenon: deregulation. Brokerage firms were multiplying overnight. The SEC was stretched thin. Anyone could open a firm with a phone, a Rolodex, and enough nerve to cold call strangers. The mob didn't need Wall Street's blessing. They built their own version. By 1982, storefront brokerage houses began popping up across Long Island, Staten Island, and South Florida. Boiler rooms, filled with cheap phones, fake enthusiasm, and relentless ambition. The walls were lined with motivational posters. The desks with stacks of scripts and call lists. The brokers were actors, reading from a script that promised fortune. Behind the glass, a mob enforcer watched every move. One of those brokers was Tommy DeLuca, a 25-year-old from Queens. He thought he was selling opportunity. He didn't realize the men paying his commission were Colombo soldiers using his firm to wash millions. When he tried to quit, he got a phone call. "Tommy, the street never lets you walk away. You either make calls or we call your mother." He made calls. He made a lot of them. Wall Street didn't notice. Or maybe it didn't care. The 1980s were a gold rush of deregulation, excess, and ego. Stocks were booming. Mergers and acquisitions dominated headlines. Greed wasn't a sin, it was a slogan. As long as the market stayed hot, nobody asked where the money came from, or who was really behind the trades. The Mafia didn't need to rob banks anymore. They became the banks. The government would later call this period the white-collar takeover. But in 1980, it was chaos disguised as capitalism. The Colombo family ran stock manipulation schemes out of Long Island. The Lucchese family controlled brokerage houses in Miami and Boca Raton. The Gambinos infiltrated investment clubs and shell companies across New Jersey. Each family learned from the other, not competing, but cooperating. The Mafia Commission had found its 1980s gold mine. In old mob terms, a racket had limits: a neighborhood, a union, a casino. But on Wall Street, there were no limits. The phone line was the new gun, and the stock ticker was the new getaway car. By the end of 1980, millions of dollars in mob money flowed through the market every week. Stocks were pumped, dumped, and destroyed. Ordinary Americans lost their savings, unaware they were victims of organized crime in Armani suits. The mob didn't just adapt to Wall Street, they redefined it. This was no longer the world of backroom deals and smoky card games. This was the digital age of deception. White shirts instead of leather jackets, briefcases instead of Tommy guns. And as the sun set over the glass towers of Lower Manhattan, the old Mafia sat back in their clubhouses in Bensonhurst and smiled. They had finally found the perfect crime. But this was only the beginning. In the years to come, the boiler rooms would multiply. The scams would evolve, and the money would grow so large, even legitimate banks would look the other way. Because on Wall Street, as one Colombo associate once said, "Everybody's a crook. We just admit it." By 1980, the lines between Brooklyn backrooms and Wall Street boardrooms began to blur. The same men who once broke kneecaps over unpaid gambling debts now carried briefcases. The accents didn't change, just the uniforms. They traded switchblades for calculators, and they called it progress. The Mafia had always relied on loyalty and muscle, the street. But now a new kind of soldier was rising, young, hungry, and educated. They came from Brooklyn, Queens, Staten Island. Children of working-class Italian families who'd grown up watching Cadillacs pull up outside social clubs, wondering what it took to get one. Some went to college, some didn't. But all of them knew one thing: the street never forgets its own. In 1981, a Colombo associate named Joseph "Joe the Broker" Macaluso made history in the most unlikely way. He wasn't a killer, he wasn't even a made man, he was a stock trader. And his idea would change organized crime forever. Macaluso ran a small boiler room brokerage on Long Island. He knew a few Colombo soldiers from his neighborhood, men who once ran protection rackets in the garment district. He told them he had something better. Why shake down a store for $2,000 when you can shake down the market for $2 million? They listened. By late 1981, Macaluso's firm, First United Securities, was running one of the first full-scale pump-and-dump operations backed by the Mafia. The playbook was simple. They'd buy cheap penny stocks, small, worthless companies that existed only on paper. Then they'd hire smooth-talking salesmen, often ex-fraternity hustlers and failed realtors, to cold call unsuspecting investors. Every call followed the same rhythm. "Sir, this company's on the verge of a breakthrough, a revolutionary product, ground floor opportunity." Behind the phones, a mob enforcer watched every move. Intimidation wasn't just physical anymore, it was psychological. If a broker missed sales targets, he didn't get beaten, he got replaced. If an investor complained, they got buried, in paperwork, not dirt. The Mafia had discovered a new kind of power: invisible control. No guns, no witnesses, no fingerprints, just signatures, just phone calls, just money. By 1982, the Gambino and Lucchese families joined the game. Their young associates, men like Michael Affatato, John Amato, and Vinnie Romano, started firms in Lower Manhattan and Miami under false names. They used intimidation not just to sell, but to silence. If a rival firm exposed their scam, someone's car would mysteriously burn overnight. If a reporter asked too many questions, a quiet phone call would remind them who they were dealing with. As one FBI agent later put it, they took Wall Street, stripped out the law, and rebuilt it like Brooklyn. Wall Street in the early 1980s was the perfect storm. Deregulation had opened the floodgates. The SEC, undermanned, underfunded, and overwhelmed, was chasing ghosts. New firms appeared every month, new loopholes every week, and for the first time, criminals didn't need to hide their profits. They could invest them. The mob poured millions of laundered dollars into the market, blending dirty money with legitimate trades. Real brokers handled fake firms made real profits. Everyone got paid. In 1982, an undercover FBI agent named Jim Duffy walked into a small brokerage in Midtown under the alias James Donovan. He was posing as a wealthy investor looking for fast returns. Within minutes, he was offered inside access to a private deal, an offshore mining company going public for the first time. A can't-miss IPO, the broker said. The broker's name? Anthony Tony Phones Perino, a Lucchese associate. Duffy remembered the pitch vividly. He talked like a street guy who learned to wear a tie. It was the Mafia, with a business degree. By 1983, the mob's presence was undeniable, yet invisible. The Colombo family dominated Long Island and the pink sheet stocks. The Luccheses took Florida and offshore scams. The Gambinos, ever ambitious, moved straight into legitimate finance, forging ties with corrupt accountants, lawyers, and bankers. Their empire wasn't built on fear. It was built on illusion. One Colombo captain told an associate, "Nobody's got to die. They just got to believe." But beneath the smooth-talking sales pitches and gleaming skyscrapers, old habits persisted. Money laundering needed muscle, debts needed collecting, and sometimes an example needed to be made. In 1983, a young broker named Rick Palermo tried to report his firm's activities to federal authorities. Weeks later, his car was found submerged in the Hudson River. Police ruled it an accident. The FBI didn't. The message was clear. This was still the Mafia's world. It just wore better suits. The profits were staggering. A single manipulated stock could net millions. The overhead was minimal, just phones, paper, and lies. The mob had discovered something better than bootlegging, gambling, or drugs. They had found the one product everyone wanted but few understood: hope, and they sold it one call at a time. By the end of 1983, the five families had woven themselves into the financial fabric of New York. Their fingerprints touched everything from penny stocks to corporate mergers. Wall Street wasn't just their playground. It was their new frontier. For decades, the Mafia had ruled the streets of America. Now they ruled the market that decided its future. And the brokers from Brooklyn, once dismissed as street kids with slick hair and loud mouths, had become the new face of organized crime. They didn't just meet the street. They became it. But their success drew attention. Whispers began to spread. Regulators started noticing strange trading patterns, and deep within the FBI's Financial Crimes Division, a new idea began to form, one that would take years to execute. A war was coming, not with bullets or blood, but with subpoenas, wiretaps, and balance sheets. The Mafia had found a new battlefield, and this time, the enemy carried briefcases too. By 1983, the Mafia's newest empire didn't smell like gunpowder or bootleg whiskey. It smelled like coffee, cigarettes, and money. Inside a cramped office on 47th Street, the air was thick with ambition. Phones rang non-stop. Printers spat out stock orders. Men in cheap suits shouted over each other, chasing the next sure thing. To the untrained eye, it looked like Wall Street. But to anyone who'd grown up in Brooklyn, it looked like the mob had moved uptown. They called them boiler rooms, high-pressure brokerage houses where every phone was a weapon and every call was war. The operators were young, brash, and fast-talking. Most didn't even know who they truly worked for. But the ones who did understood the stakes. One former Colombo associate put it bluntly years later: "You didn't sell stock, you sold the dream. And if they didn't buy, you made them regret it." By 1984, hundreds of these operations blanketed New York and South Florida. The Colombo, Lucchese, and Gambino families ran them like military units. Every office had a capo di telefono, a manager who took orders from the top. Every broker was ranked by performance, pressure, and obedience. And every single dollar that passed through the phone lines was taxed, the infamous street tax. 5% to the family, 10% if you wanted protection. And if you wanted to open your own firm, you paid a license fee, in cash. It was capitalism, organized. The mob didn't just manipulate markets, they created them. Fake companies, fake products, fake investors. Shell corporations in the Bahamas, Panama, and the Cayman Islands funneled money back to bosses in Brooklyn and Staten Island. A Colombo accountant named Ralph DeMio once bragged, "We laundered $5 million a month through companies that didn't even have a phone number." And no one on Wall Street blinked. That same year, First United Securities, once a small-time scam, went national. With new funding from Lucchese money men, it opened branches in Miami, Chicago, and Los Angeles. The brokers partied at nightclubs, drove Lamborghinis, and threw IPO launch parties that looked like Mafia weddings. They were untouchable, or so they thought. In 1984, the FBI's Financial Crimes Unit began noticing strange trading patterns. Dozens of penny stocks were rising and collapsing overnight. Anonymous investors seemed to control entire companies from offshore accounts. Agents started tracing phone records, and what they found led straight back to New York social clubs. One surveillance report from that year described it clearly. Meetings held at Casabella Restaurant, Bensonhurst. Subject, pump and dump operation. Present, associates of Colombo, Lucchese, and Gambino crime families. The mob had literally franchised fraud. But the boiler rooms weren't just criminal, they were addictive. The brokers, many in their 20s, made more in a week than their parents had in a year. They wore Rolexes, drove Ferraris, and snorted lines of cocaine between trades. They believed they were geniuses. Yet behind them, the old world watched. Men like Carmine Jr. Persico of the Colombo family and Anthony Tony Ducks Corallo of the Luccheses understood the real play. Control the brokers, control the market, and control the market? You controlled America. Meanwhile, in Miami, a young upstart named Luis Lou da Silva ran one of the flashiest firms in the game, Sunrise Investments. Its walls were plastered with motivational posters, "Greed is good. Money never sleeps." What no one knew was that Sunrise was backed by the Gambino family. Every trade, every deal, every miracle IPO was another stream of laundered money from casinos, construction rackets, and narcotics. When a broker crossed the family, he didn't get a pink slip. He disappeared. By 1985, at least 6 financial advisors had vanished without explanation, all connected to mob-linked firms. In February 1985, the FBI launched Operation Red Herring, a covert probe targeting organized crime's presence in penny stocks. They wiretapped phones, flipped minor brokers, and began mapping the network. One agent described it as the mob's most sophisticated scheme since Prohibition. But there was a problem. Money moved faster than the law, and every time the FBI shut down one brokerage, 3 more appeared, under new names, new faces, same families. In April 1985, tragedy struck Wall Street's underworld. Joseph Macaluso, the broker who had first brought the Mafia to the market, was found shot twice in the head in a parking lot in Queens. Police suspected a robbery. The FBI suspected silence. Macaluso had become too visible, too confident. And in the mob's world, that was fatal. After his death, the business didn't slow down. It multiplied. By 1986, the boiler rooms were churning more than $1 billion in fraudulent trades annually. Firms like Stratford Equity, Prime Atlantic, and Empire Financial Group were fronts for entire families. They controlled public companies, bribed auditors, and faked press releases. In one notorious scam, they created a mining company that didn't exist. Silver Star Minerals. It had no mines, no employees, not even an office. But brokers pushed it to investors as the next gold rush. Its stock price tripled in a month, then collapsed. The mob walked away with millions. And yet their true genius wasn't theft. It was camouflage. The Mafia no longer needed guns to control power. They controlled it with ink and illusion. Their operations ran through law firms, shell corporations, and banks. They had become ghosts inside the system. One Gambino soldier famously said, "The feds can't raid the stock market." For a while, he was right. By late 1986, the streets of Little Italy had grown quieter. Gone were the smoky backrooms filled with dice games and whiskey. Now, deals were made in boardrooms, and fortunes were stolen with signatures instead of switchblades. The mob had found a better racket than gambling, extortion, or drugs. It was legal, at least until someone asked too many questions. But that silence wouldn't last. Inside the FBI's Manhattan office, new evidence was piling up. Wiretaps, banking records, confidential informants. The bureau had names, firms, and family ties. They just needed proof. And soon, they'd get it, from the inside. By 1986, the Mafia had learned something Wall Street had always known. Money isn't about where it comes from. It's about where it goes. And nowhere was that lesson clearer than in the shiny new world of junk bonds. They were the miracle fuel of the 1980s. Risky, volatile, and intoxicating. These high-yield corporate securities promised wealth beyond imagination, if you were bold enough to play the game. For legitimate investors, junk bonds financed America's corporate revolution. For the mob, they became the perfect laundromat. Dirty money went in, clean profits came out, and the government never saw a thing. The center of it all was Michael Milken, the so-called junk bond king of Drexel Burnham Lambert. He wasn't a mobster. He was something more dangerous, a genius. Milken saw a way to take failing companies, flood them with borrowed money, and flip them for profit. Wall Street called it innovation. The Mafia called it opportunity. By 1987, crime families had evolved from street enforcers into financial predators. Through brokerage fronts and corrupt financiers, they began buying into high-yield markets. It wasn't just about profit, it was about power, because controlling debt meant controlling companies, and controlling companies meant laundering money legally. In Brooklyn, a Colombo soldier named Frankie Banks Sciortino ran one of the earliest mob-linked junk bond networks. He partnered with mid-tier investment firms willing to look the other way. His pitch was simple. You give me $1 million dirty dollars, I give you $1.5 million clean ones by Christmas. Sciortino's cash moved from loan sharking operations to shell companies that invested in high-yield securities. From there, it cycled through Drexel-backed firms and came out looking like legitimate returns. Every dollar of blood money was reborn as a dividend. The FBI began noticing strange overlaps. Unknown investors buying into the same junk issues as major corporate raiders. Cash appearing from nowhere, losses written off in shell companies that didn't exist. In one memo dated August 3, 1987, federal agents described it as a network of organized crime-linked entities leveraging junk bonds as a vehicle for mass-scale money laundering and influence over legitimate corporations. They called it the Golden Web, and the web stretched far. Through crooked accountants in New Jersey, Gambino money flowed into real estate firms and casino projects. Lucchese fronts invested in leveraged buyouts in Chicago and Dallas. Even the outfit, Chicago's own syndicate, joined in, funneling millions from Las Vegas skim operations into Wall Street portfolios. For the first time, organized crime was investing in America itself. While the press hailed men like Milken and Ivan Boesky as titans of finance, the mob operated in the shadows just behind them. They used the same tools, the same brokers, even the same banks. But their profits weren't just measured in dollars, they measured them in freedom. Because every junk bond deal gave them legitimacy and a shield from prosecution. No one questioned where the money came from when it arrived through a respected firm. A former federal investigator later put it bluntly, they figured out how to wear suits without getting dirty. By 1988, the overlap between corporate finance and organized crime became impossible to ignore. Drexel Burnham's deals were flooding markets with billions in borrowed cash. Behind the scenes, mob-connected shell companies like First Continental Holdings and Alpha Capital Group quietly bought in. Those companies were fronts, their executives fake, their offices rented, their phone lines answered by offshore operators. But they moved millions through junk bond purchases tied to Drexel accounts. And the returns were staggering. 10%, 15%, even 20%. The same money that once paid for bootlegging trucks and nightclub bribes was now financing corporate takeovers. In October 1987, Wall Street crashed, the infamous Black Monday. Billions were wiped out in hours. Traders panicked. But the Mafia, they thrived. Because they weren't gamblers anymore. They were lenders. After the crash, liquidity vanished. Corporations were desperate for cash, and mob-backed financiers had plenty of it, clean and ready. They offered bridge loans at brutal interest rates, disguising the deals as legitimate debt restructuring. It was the oldest hustle in a new disguise, loan sharking for corporations, Meanwhile, the FBI was closing in. Through Operation Polar Cap, federal agents tracked laundered money from drug cartels, bookmaking operations, and Wall Street investments, all converging in the same accounts. The Mafia's fingerprints were everywhere, but their moves were subtle, disciplined, and protected by a maze of legal entities. They didn't need violence anymore. They had lawyers. By 1989, Drexel Burnham Lambert began to crack under the weight of federal investigations. Michael Milken was indicted on 98 counts of racketeering and fraud. The headlines screamed about greed, corruption, and Wall Street excess. But in the alleys of Bensonhurst and the back rooms of Bay Ridge, the mob watched quietly. Milken's empire collapsed, but theirs remained intact, because they'd never needed fame, only access. When the dust settled, mob-connected investors simply moved their money elsewhere: hedge funds, private equity, offshore trusts. The golden web had shifted, but it didn't die. In the end, the junk bond era did what no racket had ever done before. It gave the Mafia a blueprint for invisibility. No blood, no guns, no trails. They had become part of the American financial machine itself, and the world didn't even know it. The 1980s had turned the Mafia from gangsters into financiers. But with power came arrogance, and with arrogance came exposure. Because while the mob mastered money, one of their own was about to betray the system from within and set off the largest financial crime probe in American history. The next chapter would reveal how the walls finally began to crack, and how the same greed that built their empire would start to destroy it. By 1989, the Mafia had gone corporate. The street gangs of New York had traded brass knuckles for briefcases, and the new racket wasn't in the alleys of Brooklyn. It was inside the glass towers of Wall Street. Gone were the days of smoky card rooms and loan sharks on corners. The real action now came through phone lines, ticker symbols, and whispered tips. In this new world of money and manipulation, the mob found its next great empire: the small-cap stock market. It was a perfect fit. Penny stocks were chaos, unregulated, unpredictable, and ripe for exploitation. The rules were loose, the players greedy, and oversight nearly non-existent. For the mob, it was the same hustle they'd always run: rig the game, control the odds, and cash out before anyone knew what happened. Only now, instead of dice and bookies, they had brokers and balance sheets. The scam was deceptively simple. A mob-connected firm would target a tiny company, often one no one had ever heard of, and quietly buy up its stock. Then came the pitch. Salesmen, half brokers, half con artists, would flood the phones, calling ordinary investors, promising quick riches and insider opportunities. As demand soared, prices shot upward in a carefully manufactured frenzy. Then, at the peak, the insiders sold it all, dumping their shares and leaving the victims holding worthless paper. It was called a pump and dump, and it worked almost every time. Throughout Brooklyn, Queens, and Long Island, small brokerage houses popped up like weeds, flashy offices with aggressive young brokers who could talk their way into anyone's wallet. Behind those brokers stood the mob. Colombo, Gambino, and Lucchese soldiers financed the firms, provided security, and ensured that no one asked too many questions. The brokers made millions in commissions. The mob took their cut, and anyone who didn't play along risked a midnight visit. One former broker later said, "You'd get a call from some guy you never met. He'd say, 'Nice commission check. Be a shame if someone mentioned it to the IRS.' That was all it took." Among these new hustlers was a young, fast-talking Queens broker named Jordan Belfort. His firm, Stratton Oakmont, became a symbol of the era: chaotic, ruthless, and wildly profitable. The firm's culture was pure frenzy: phones ringing non-stop, brokers shouting until their voices cracked, champagne flowing when sales hit record highs. But beneath the energy and greed lay something darker. Some of Belfort's early backers had direct ties to organized crime. A few were relatives of Gambino associates. Others had previous arrests for securities fraud linked to Lucchese operations. Through these connections, the Mafia found the perfect front: a legitimate Wall Street firm where they could launder millions, manipulate markets, and turn stock fraud into an industrial operation. The mob's influence wasn't just financial, it was operational. They dictated which stocks to inflate, who to silence, and how to move the money. Mob-controlled brokers even traded under fake names to artificially drive up prices. By 1991, some estimates suggested that nearly half of all penny stock scams in the U.S. had some level of mafia involvement. They had turned Wall Street into a digital version of the old neighborhood, a protection racket built on data, not bricks. Violence didn't vanish entirely. When a Florida broker refused to share profits with his mob partners, his office mysteriously went up in flames. Another broker, who tried to alert regulators, was found beaten unconscious in a parking lot. The methods hadn't changed, only the setting. The suits were sharper, the offices cleaner. But the fear was the same. Federal authorities began to notice. To the FBI and SEC, it was a new kind of organized crime, one that left no blood, only paper trails. Investigators started connecting the dots. Brokerage firms with unexplained cash infusions, traders related to known mobsters, intimidation that crossed state lines. The pattern was clear. Organized crime had found its way into America's financial heart. In 1992, the FBI, IRS, and SEC formed a joint task force to investigate. They called it Operation Uptick. Agents began planting wiretaps, flipping brokers, and building cases from the inside. What they found stunned even seasoned mob investigators. Dozens of firms were implicated: Stratton Oakmont, Hanover Sterling, A.S. Goldman & Company's D.H. Blair, each connected by the same hidden network of money, intimidation, and silence. The FBI described it bluntly. This wasn't a scam. It was a system. A machine built to bleed Wall Street dry. For mobsters, it was paradise. They didn't need to rob banks anymore. They owned the banks. They didn't need guns, just phones. No more street corners. No more bloody wars over territory. The new rackets ran through keyboards and offshore accounts. It was crime without fingerprints. By 1993, the system had become too big to hide. Stratton Oakmont was under investigation. The SEC began freezing assets and suspending licenses. Prosecutors started summoning witnesses, and the first brokers began flipping for leniency. The empire that had made billions through deception was starting to crack. But the Mafia wasn't finished. The old families didn't surrender. They adapted. And as the FBI closed in, the mob prepared for a different kind of war, one fought not with bullets, but with lawyers, shell companies, and silence. The days of easy money were ending. But for a brief, glittering moment, the Mafia had ruled Wall Street, just as it once ruled the streets. And the echoes of that control would haunt the financial world for years to come. By 1993, the Federal Bureau of Investigation had seen enough. Years of investigating the Mafia's infiltration of Wall Street had built a picture too large to ignore. Penny stock scams, pump and dumps, shell companies, and mob-linked brokers weren't anomalies anymore. They were part of a massive organized system that spanned New York, New Jersey, and even Florida. The mob had transformed financial crime into a machine, and the FBI decided it was time to pull the plug. They called it Operation Uptick, a nationwide multi-agency operation designed to target organized crime's growing foothold in the securities markets. What made it unprecedented was scale. Never before had federal agents focused so heavily on the Mafia's white-collar operations. They weren't chasing bank robbers or street-level bookies. They were chasing executives in suits, brokers in offices, and invisible networks that spanned the nation. The plan was meticulous. The FBI deployed hidden microphones in brokerage offices, tapped phone lines of suspected mob-linked firms, and cultivated confidential informants within the Mafia itself. These insiders were dangerous, unpredictable, and motivated by survival or greed. But their testimonies offered the clearest picture yet of how organized crime had weaponized finance. By late 1994, the evidence was staggering. Wiretaps revealed mob captains issuing orders over secure phone lines, instructing brokers on which penny stocks to inflate, which accounts to manipulate, and which investors to intimidate. Threats were made not on street corners but through conference calls and fax letters. One informant described it as, like watching the old neighborhood, just with calculators and cell phones. The Colombo and Gambino families, once known for their street wars and speakeasy strongholds, were now exposed as orchestrators of a massive financial casino. Brokers with mob relatives were pumping small-cap stocks, laundering dirty cash, and skimming profits that could reach millions in a single week. Every fraudulent trade was another thread in a web that linked Wall Street to organized crime. Operation Uptick wasn't a single strike. It unfolded over years. The FBI coordinated with the SEC, IRS, and even state regulators to synchronize arrests, subpoenas, and asset freezes. Raids were conducted in Manhattan skyscrapers, suburban brokerage offices, and even the homes of mob captains. By 1996, dozens of mobsters and brokers were facing charges ranging from securities fraud to racketeering, wire fraud, and conspiracy. The operation revealed the sophisticated ingenuity of the Mafia's financial network. Front companies, often operating under entirely legitimate names, masked mob involvement. Accounts were layered with offshore trusts and shell corporations. Even auditors and accountants, complicit or coerced, provided plausible deniability. The Mafia had mastered the art of invisibility. For years, they had operated in plain sight, benefiting from an intersection of ignorance, greed, and the complexity of the financial system. Among those indicted were several brokers who had served as the Mafia's eyes and ears on the trading floor. Many had relatives in crime families, making them both trusted operatives and effective conduits for laundering illicit funds. When the trials began, prosecutors presented mountains of evidence: bank records, trading logs, recorded conversations, and first-hand testimony from former associates. The courtroom drama revealed how street-level extortion had evolved into boardroom manipulation. Even with the arrests and prosecutions, the cultural shift the Mafia had enacted on Wall Street could not be fully erased. While Operation Uptick dismantled specific operations and imprisoned key figures, the model they had created, co-opting finance to launder money and enforce control, left a lasting blueprint for future criminal enterprises. Analysts noted that the mob had proven that financial systems could be manipulated with the same ruthlessness once reserved for territory disputes and bootlegging wars. By 2000, Operation Uptick had concluded, leaving behind a trail of convictions and shattered mob-linked firms. Members of the Colombo and Gambino families were convicted or forced into semi-retirement. Brokers went to prison or were permanently banned from trading. The operation was hailed as one of the largest and most sophisticated white-collar takedowns in FBI history. Yet the story was not just one of arrests. Operation Uptick revealed a fundamental evolution. The Mafia had entered a new era. They were no longer solely the kings of the street. They were architects of financial chaos, masters of perception, and, in many ways, innovators in crime. The legacy of their schemes would be studied for decades as law enforcement sought to understand the intersection of organized crime and modern finance. When historians look back, Operation Uptick stands as both a triumph and a warning. It dismantled a criminal empire's control over Wall Street, yet it also highlighted the audacity, intelligence, and adaptability of organized crime. The mob had turned dollars into power, intimidation into strategy, and financial markets into a playground for the bold and the ruthless. In the end, Operation Uptick was more than an investigation, it was the reckoning. And as the gavel fell on the last trials, one truth remained clear. The Mafia could be imprisoned, but the lessons they taught about greed, manipulation, and invisibility would echo far beyond the courthouse walls. By the turn of the millennium, the Mafia's reign over Wall Street had reached a breaking point. Years of investigation, arrests, and relentless pressure from federal authorities had begun to dismantle the carefully constructed empire. Operation Uptick, though concluded in 2000, had set off a cascade of prosecutions, indictments, and civil lawsuits that the old families could not withstand. Dozens of key players were either behind bars or facing long trials. Brokers once flaunting mob connections and manipulating markets were disbarred, jailed, or permanently barred from trading. Colombo, Gambino, and Lucchese families saw their influence in the financial sector crumble. Offices once humming with fraudulent trades sat empty. Phone lines went silent. Shell corporations were dissolved. The golden era of mob-controlled penny stocks had ended. Yet, even as the Mafia faded from the headlines, the structural innovations they had pioneered refused to vanish. The blueprint they left behind, offshore accounts, shell companies, layered transactions, and subtle market manipulation, remained intact. It was a model not of brute force, but of invisibility and precision, one that could be adapted by anyone willing to skirt the law. Where street-level intimidation once enforced compliance, now legal loopholes, complex corporate structures, and financial sophistication enforce the same control. The old guard's disappearance did not end market abuse. It merely transformed it. In the years following the mass arrests, white-collar crime became cleaner, smarter, and harder to trace. Fraudulent trades moved faster, across more complex global networks, and often beyond the reach of traditional regulators. Corporate scandals, insider trading, and Ponzi schemes of the 2000s bore the unmistakable fingerprints of strategies first honed by mobsters decades earlier. For the families themselves, this was a bitter irony. They had spent decades mastering a system, only to see new generations of fraudsters exploit the same tools without risking lives in the shadows of organized crime. Money flowed through digital accounts and international exchanges, largely invisible and untouchable by local law enforcement. In many ways, the mob had become obsolete, but their influence persisted in the very fabric of modern financial crime. Still, the collapse of their Wall Street operations had consequences beyond money. Law enforcement gained invaluable experience, learning to follow paper trails, interpret digital signals, and cultivate insiders in complex white-collar networks. Prosecutors developed techniques to dismantle layered shell companies and trace illicit funds across borders. Operation Uptick and subsequent prosecutions became case studies in both the capabilities and limits of fighting organized crime in a financial context. Even as mobsters receded into retirement or low-profile business ventures, the fear and respect they had cultivated endured. Brokers, executives, and investors knew the stories of the old guard, and the shadow of the mob's tactics influenced compliance, oversight, and risk management practices for years. Their legacy was not one of bullets or street wars. It was one of systems, strategy, and the cold, calculating mechanics of modern crime. By the end of the 2000s, the Mafia's financial empire was no longer front-page news. Headlines now focused on corporate scandals, hedge fund collapses, and Ponzi schemes. Yet for those who knew the history, the echo of mob ingenuity lingered in every market manipulation, offshore transaction, and sophisticated laundering scheme. The physical presence of the mob had vanished, but their lessons in power, stealth, and exploitation of human greed remained embedded in the financial world. In retrospect, the fall of the financial mafia marked both an ending and a beginning. It was the end of an era where organized crime directly controlled markets with overt ties and threats. But it also highlighted a new reality. White-collar crime had evolved, cleaner, faster, and often more dangerous because it no longer required the visible hand of the streetwise gangster. The mob's physical dominion may have crumbled, but their blueprint lived on, shaping the future of financial deception in ways few regulators could fully anticipate. The 2000s closed the chapter on the Mafia's direct reign over Wall Street, but it opened a new, invisible war. And in that war, the lessons of the old families, the art of manipulation, secrecy, and control, continued to inform every fraudulent transaction, offshore maneuver, and artificially inflated stock. The mob had fallen, but their methods had become immortal.